Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 29th of January. I'm Daniel Lam, your host for the podcast. First of all, I'd like to apologize because my voice is a little bit iffy today, given the weather change, so sorry about that. Well, the FOMC was an uneventful end to an extremely eventful January. The Fed stayed put, as was widely expected. There was little incentive for imminent easing, with growth seen as solid, the labor market stabilizing, and inflation staying elevated. There was a slightly less dovish tone in the statement, given the more upbeat language on economic activities and the unemployment rate. But market pricing continues to suggest that the Fed will stay on hold for the rest of Powell's term as chair. A further cut is not fully priced until the July meeting. Now, we continue to believe that the Fed will be cutting rates 3 times this year. It is to Trump's interest that the stock market and the economy do well this year, particularly with the looming midterm elections. Now, as a reminder, since World War II, there was only a 55% probability where U.S. equities made positive returns in the midterm election year, versus 76% for the other years. The S&P 500 registered an average return at 3.8% in midterm years, versus 10.8% average gain for the other years. But statistics on the Fed rate cut cycle is on Trump's side. Now, providing that it is a non-recessionary period, historically, the S&P 500 returned 17% in the 12 months following the first Fed rate cut. Now, the Fed did the first rate cut in this cycle in the middle of September last year, when S&P 500 was at 6,600. So this is pointing towards a possible level at around 7,722. That's very close to our 12-month price target for the index at 7,800. So we're maintaining our overweight on US equities and would be adding on dips. Finally, a comment on the DXY dollar index. Now, the dollar index saw a mild uptick after being under pressure, heavy pressure actually, earlier this week, and testing the key support level at 95.20 that was in place since early 2022. This de-dollarization narrative had picked up in pace due to the saga in Greenland, and then Trump's comment that he's comfortable with the dollar's recent decline. It is also due to the upturn in the global cycle, where there was improving global PMIs and trade volumes making new highs. This is historically a good environment for cyclical currencies. However, the US dollar positioning is near extreme bearish right now. The long positioning is below the 10th percentile versus history, so it can be susceptible to sharp short squeeze. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.